So welcome to lesson 2 of our 9-step lesson program in do-it-yourself financial planning. Happy Valentine's Day. Let's see here. I was asking earlier if anybody had, I think the answer is no. We do not have any homework not to be turned in completed. Because I was going to ask you, what are you going to do about Social Security or a pension that you might have coming down the road? And we'll talk about that later on, in particular in lesson 6. That is an issue that comes up in trying to put together a balance sheet. So here's the lecture notes, and tomorrow I'll hand out this spreadsheet that'll have lesson 2. So the program again is tonight is the aggregate household sector balance sheet and the overall financial system. And as you can see, each spreadsheet is going to be cumulative. So by the end, you'll have all 9 lessons on one spreadsheet. So basically, that means you can toss the spreadsheet from last week. I also will have a tab for lesson 3, which is next week on time value of money. And the other homework to be turned in was to see if you could replicate Bill Ackman's lemonade stand projections. And he basically went through the first 5 years. And the way I've set it up here is the end of year 0 is right now. And we got our initial balance sheet, which was $750 in cash, a debt of $250, equity of $150 or $1,500. And then year 1, you add a stand, and then you make assumptions about number of cups and price per cup and cost of materials, and create an income statement, which we came up with a -15 for net profit. And then you get a cash flow, which was the -15 plus depreciation. So from operations, $45, and then $300 negative for buying the stand. And so that tells you the change in cash was -255, 45 minus 300. And so that means that the cash box went down by 255 from 750 to 495, and the equity went down by 15. So, but we have $300. We have enough money to buy another stand. And so we have our growth assumptions. You said buy a second stand, assume we can have a higher price and 5% more cups, and et cetera. And he goes out to 5. And I was asking, see if you could replicate this. And I was telling you that if you take it out forever, it gets really explosive. So the one trick, if you wanted to do that, is how many stands can I buy? And it depends on what your cash box is at the end of the prior year. So if the cash at the end of year 5 is 2,160, so how many stands can we buy? Well, how many ways? The nice little function in Excel is int, which is the integer function. So the int of 1.1 is 1, int of 8.2 is 8. And so if you take int of the cash, which is box 330 G37, divided by 300, that automatically tells you how many new stands you can have given your cash. And then the second thing, the trick is to say, well, okay, the number of stands has got to be the ones that we had last period, which were 7, plus the new ones, which is 7 more, minus the ones that are depreciated away, which were the ones that were new 5 years ago. So anyway, once you get these two things, you can take this column and just copy it to the right as far as you want. And I said I copied it out to 20 years, and we had 2.1 billion stands. And we had profit of 4 trillion. We had cash flow of 4.1 trillion, and that allows us to buy 12 billion stands for next year. So again, the risks or the downside of mindless extrapolation using a spreadsheet. And final new tab is, I mentioned some of these references last week, and I'll add to them as we go through the program. But let's see, here's somebody else coming in. But anything that John Bogle writes is worth reading. Warren Buffett's is, so John Bogle is the father of the index fund and of passive investing. At the other end of the extreme, the most successful active investor ever is Warren Buffett, and he hasn't written any books, but he has written the chairman's letter for Berkshire Hathaway annual reports for the last 50 some odd years. And you can access these in the spread in this link I have. And they're, unlike normal chairman's letters, are actually very interesting and full of useful information. Alexander Green is the gone fishing portfolio I mentioned last time. And whenever I have a new client for my pro bono advisory service, I recommend they read George Classen's book, The Richest Man in Babylon, which is a small book, paperback, 120 pages, but the first 20 is all you need. The other, like 7 stories, goes through the same argument. And I've written an essay. If you don't want to go buy the book, I have a 500-word essay on that describes the chief story in this. And maybe I'll pass that along with the notes tomorrow. And the cool thing about the gone fishing portfolio is Green is trying to help people not make the mistakes. I think I mentioned last time, if the overall market produced a 10% return over a period of time, an active manager who was charging 1% fee probably would get that 10 minus the fee, you'd get 9. But actual real world retail stock investors get 3 or 4 or 5%. You get way, way worse because they make mistakes. And Alexander Green has a very simple strategy to avoid making the mistakes. The mistakes can be too much trading, bad timing, buying when the market's high and selling when the market's low, not diversifying enough, or too little equity or too much equity. So the gone fishing portfolio has 10 funds. I think we mentioned 3 of them last time, VTI, VB, and VEU, but he has 5 equity funds, 3 bond funds, and 2 real asset funds. And although it sounds, to me, it's a little too complicated, you don't really need 10 funds, but as he puts it, you only need to spend maybe an hour a year on your portfolio. You set it up in about an hour, and then once a year, you see if it's deviated from your target and whether you need to make a change. Other than that, you can go fishing. Then there's Bill Ackman's, this is the same video we talked about last week. And finally, there's a wealth of information on the Khan Academy. Seems to me perhaps the greatest motto. The Khan Academy motto is all the world's knowledge available to anyone, anywhere for free. And they've got thousands of videos, and on personal finance, they've got about 100 of them. And they're all 6 or 8 minutes, so you can go through them pretty quick. But they're on how to save, interest in debt, investments, housing, whether you should buy or rent, car, whether you should buy or lease, taxes, and college. In fact, they have about 40 videos just on college finance, which was very interesting when my granddaughter was applying for college a couple of years ago. Now, as it turns out, none of the strategies that were recommended at the Khan Academy were actually relevant for us, but it was pretty interesting. Okay, so tonight we are talking about the overall financial system. And we have references to flow of fund, to Federal Reserve publications, the quarterly flow of funds report, and the triannual survey of current consumer finances. So the main purpose of the financial system is to supply funds from lender savers to borrower spenders. The main lender saver is the household sector. This is in the aggregate. There are naturally many, many households that are actually borrower spenders instead of lender saver. But in the aggregate, most of the funds that support enterprise come from the household sector. And the main borrower spender is the business sector, and of course, the federal government. So here's a picture of the flow of funds through the financial system. The lender savers are in yellow households. Some business firms are lender savers because they acquire so much cash that's more than they can use, and so they acquire huge portfolios of securities. But mostly it's the household sector. And then the borrower spenders in the light blue are business firms and government. And there's 2 ways by which funds move from lender savers to borrowers investors. One is direct finance, where lender savers, borrower spenders issue securities like bonds or stocks, and lender savers buy them directly. And so that's direct finance through the financial markets. Much bigger, much more important is indirect finance, where financial intermediaries are in between the households and the business firms. And that's so this is firms issue securities which are purchased by financial intermediaries. Financial intermediaries include commercial banks, insurance companies, mutual funds, and other types of funds. Households buy cool products like deposits, insurance policies, mutual fund shares, etc., from financial intermediaries, and then the financial intermediaries in turn invest in the securities issued by business firms. Indirect finance is much bigger than direct finance. And one other distinction is between the primary market and the secondary market. The primary market is the market for newly issued securities. The primary market addresses the primary purpose of the financial markets, which is get that money from lender savers to borrower spenders. The secondary market consists of the trading in existing securities and funds. So after IBM issues debt or equity, that's traded for the next umpteen years between investor A and investor B. That doesn't raise any new money for IBM. Secondary trading is purely transactions it's not raising new money. Secondary market activity is much larger than primary activity. Like 99% of all trades is in the secondary market, not the primary market. So you might say, well, wait a minute. If the whole point of this financial markets is the primary market, why is the secondary market so dominant? And I think the reason is the purpose of the secondary market is to provide liquidity to holders of securities and to value streams of future cash flows. That is, they put a price on IBM and they allow you to sell IBM. So how many people would want to invest in stocks or bonds if there was no possibility of getting the money back if they needed it? So that's the purpose of the secondary market, to provide liquidity. Okay, types of financial intermediaries. Again, well, all intermediaries raise funds by issuing claims or creating attractive products and then invest those funds in securities of some sort. So commercial banks raise funds through deposits and borrowing, and they make loans and invest in securities. Insurance companies raise funds through the sale of policies, and they invest in securities and real estate. Mutual funds raise funds through the sale of their own fund shares, and then they take that cash and they invest in securities. Pension funds raise funds through employee and employer contributions, and then invest in securities and real estate, etc. Hedge funds raise funds through borrowing and the sale of fund shares. Endowment funds raise funds through alumni contributions. So who are the portfolio managers? Answer: anyone who manages a portfolio of assets and liabilities, that is, a balance sheet. It includes mutual fund managers, pension fund managers, hedge fund managers, the investment officers at insurance companies, the investment officers at endowment funds and banks, and 130 million households. So every household has a balance sheet, and therefore there's 130 million portfolio managers in the that constitute in the aggregate the household sector. So each quarter, the Federal Reserve publishes a report called the Flow of Funds Report. Among other things, this publication shows the aggregate household sector balance sheet, HH for household. Assets are broken down in the same fashion that we looked at last week, by real and financial assets, and the financial assets are further broken down into, or maybe further broken down into, equity and fixed income. At the end of 2021, total assets of the household sector were 160 trillion. Total debt was 17 trillion, and therefore total net worth was 143 trillion. And here is a breakdown. So the headline numbers are 160 trillion assets, 17 trillion debt, 143 trillion net worth. And then when you break it down, it's real and financial. Under real, there's 48 trillion, of which most of it is real estate, and the rest of it is durable goods like automobiles and so on. But anyway, my key financial or asset classes, as we discussed last week, are real, equity, and fixed income. So the real here is 48 trillion, and the overall allocation in the household sector to real assets is 48 over 160, or 30%. So the financial assets are 112 trillion. Now, and I calculate them to be 66 of equity. Now, it has to be calculated because what's shown in the flow of funds report, they show direct holdings of equities by households, and then they show mutual fund shares. Well, some mutual funds are equity and some are fixed income. So I use a rule of thumb that 60% of mutual fund assets are equity. Same thing is true. They're giving you a number for total pension funds of about 30 trillion. Well, again, you got to break that down, and they don't do it for you. So I'm assuming 60% of pension funds are equity. So and then finally, there's a number for non-corporate equity, meaning private equity, ownership of a company that's not publicly traded. So the total of that is 66 trillion. So the household allocation to equity is 41%, 66 over 160. And finally, the remaining number is fixed income. That is 112 minus 66. And that's 29%. So notes on the household balance sheet. Publicly traded equity is measured at market value. Non-public equity and real estate are measured at appraised value. Fixed income and debt are measured at book value. That is, what's the balance of the debt outstanding. As of the end of 2021, the household sector asset allocation was 40% equity, 41% equity, 29% fixed income, and 30% real assets. In lesson 7, we'll talk about the target asset allocation, and it could be different for every household. But as a starting point, I'm going to recommend this allocation: 40% equity, 30% bonds, 30% bonds and cash, 30% real assets. Now, moving on, the average household net worth may be computed by dividing total net worth, 143 trillion, by the number of households, 130 million. And when you do that, you get $1.1 million. Now, this may not or should not ring true. Last week, we pointed out that only 10% of households have $1 million or more. So how can it be the average? And the answer is, what's going on is that the distribution of net worth or wealth is highly skewed, with the mean or average being well above the median. If you want to look at the typical household, the median, or at the distribution of wealth, we can use another Federal Reserve publication called the Survey of Consumer Finances. The SCF is a triennial detailed financial survey of approximately 5,000 households. The last one was done in 2019, at least the one that's been the last one that's been reported is 2019. From the SCF, we can find household income and wealth by quartile and broken down in various ways, including by age, income, race, and education. From the 2019 survey, the median net worth of all households is 123,000, well below the average of 1.1 million. For households headed up by a senior, the median is 266,000. And people with college degrees tend to have higher net worth as well. From this data, it might appear that older households are richer than younger households, but this appearance may be deceiving. In lesson 6, we expand upon the traditional balance sheet to derive the augmented balance sheet. The augmented balance sheet includes the current assets, is what we talked about so far today and last week. Also includes the present value of future after-tax income, which economists sometimes call human capital. It also includes the present value of future after-tax retirement income. And so back to the question of how to handle Social Security, you calculate the present value of it and call it an asset. And next week, on the time value of money, we explain this concept of present value and how you go about doing that calculation. And on the other side of the ledger, this is the total financial resources available to you, and then the total obligations are your current debt, the present value of any future contributions, a legacy or family money that you might be planning on creating. And by subtraction, we get the present value of future consumption. So in lesson 6, with the augmented balance sheet, we can calculate for any given household, what is the present value of future consumption? And then when you spread that out smoothly over a remaining lifetime, you get the feasible annual spending. And then the next step is, what is actual annual spending? And so long as actual annual spending is equal to or less than feasible, you're golden. And so we can use the augmented balance sheet to estimate feasible lifetime consumption for a given household. So in the next lecture, or lesson. Next lecture, we cover lesson 3, the time value of money, including the mechanics of calculating present value. So in terms of homework to be turned in, I really don't have any, unless you want to play around with that Ackman spreadsheet. And oh, somebody has joined. Elaine, I saw you join. And who is iPad Air?
That's me, Camilla.
Hi, Camilla. Nice to see you.
Hi.
Okay, so before we break, are there any questions? Before we started tonight, I think it was Barbara was trying to confirm that I'd like to see a note about what you would really like to accomplish in this class. And yes, that is true. It's homework not to be turned in. Oh, no, sorry, homework to be turned in. Send me what is the primary objective that or primary thing that you'd like to get out of this class. So any other comments or questions? The class interaction has been great. I've never been an expert at eliciting class interaction. I hated the Socratic method when I was a student. I've avoided it as a teacher.
I did have one question that occurred to me last time. If you own a business and you're doing a balance sheet, then do you have to do one for your household and one for your business separately?
Well, if you were trying to do business planning, sure, but for your household balance sheet should include an estimate of the equity of your business, the value of your stake in the business.
Got it.
And that would be under equity, under the equity allocation.
Okay.
Yeah.
Okay.
Anything else? You're remarkably quiet there, Judy.
We just watched the lemonade stand video beforehand, so
oh yeah,
there's a lead up to this.
Yeah, I think at some point in there he says, you know what, I did say it's all you need to know about in 45 minutes, but actually there's a couple other things you might want to learn. I think he might have recommended a couple of the books that I have, but maybe not. Anyway, yeah, it's a terrific video.
Okay.
With that, if there's nothing else, I will sign off and see you guys next week.
Perfect.
Okay, doke.
Have a nice Valentine's Day.
Thank you.